Virgins Elite Masterminds, what's going on? This is Diamond Life. So I'm basically shooting this video to show you a pattern and to show you when not to trade. Okay. So this is important right here because a lot of us don't know when to trade and when not to trade. Okay. So let me show you this. I trade US 30. Okay. But I use S&P 500 and I use NAS 100 as a guide. Okay. And of course the DXY, which is right here. Okay. So, so I use DXY as a guide. Now, let's go back to in the morning. Okay. So what I want to talk about is the PM trend. Okay. Now, right here we have bearish divergence. You see price going up right here, and then when I go to NAS 100, excuse the background noise. Sorry about that. The NAS 100, this is S&P 500, is up right here, but then when I go to NAS 100, it is pushing down. Okay. So right here, you can see it pushing down. So this is clear bearish divergence. Because ICT says, what is the trend? What is the divergence between, so it was down, down, up. So this is bearish divergence. So price eventually did drop. Okay, but I didn't take a trade today because right here, I wasn't sure if price was going to go up or go down, but this is why you need to use the DXY. So maybe this should be, the title of this video should be something else. Maybe it should be the importance of understanding intermarkets, what ICT call intermarket relationships. Because right here, we had bearish divergence. So basically, based on, if you just looked at divergence itself, then you would be thinking like, okay, well, price is going to drop. Okay, because price was up, it was up here. We had an up, up, down. So right here, US 30 was up. NAS 100, SP 500 was up. But right here, we have NAS 100 being down. So that's bearish divergence, right? So just going off of that, you would have went short and you would have got killed right here, especially if you was trading US 30. I'm talking about when price was here. Okay. So why didn't I go short? Because I actually put a timeline right here. I said I want to go short. I think it's right here in this. I said I want to go short somewhere on here. But basically, I want to go short right here, but I didn't because as I go to the DXY, I see when price was right here, that price respected this 5-minute bearish mitigation block. Or is this a breaker? Yeah, this is a breaker because price went higher than this high here. So this is a 5-minute bearish mitigation, bearish breaker. And I saw that price respected this, meaning that it came up into this block right here and it didn't close above. It closed above slightly right here. But of course, on the 15-minute chart or the 10-minute chart, you would have saw that this is a wick. So basically, I saw that price was respecting this. So I was like, okay, so why would I go long? Because remember why would I go short? Because when price is going down on DXY, usually it wants to go the opposite way here. So you see the time, like right here. This is the whole title of this video is when to not take a trade and the importance of intermarket relationships. So remember, I want to take a short right here. I want to take a short all the way down. Don't you see my squiggly line right here? I thought price was coming down here to consequent encroachment or mean threshold, which is 50% of this range from 1:30 to noon. This is how ICT teaches it. From noon to 1:30 is a range that's created. So I'll put the line right here on 1:30. So this is 50% of that range. But I want to go short right here and take it all the way down here. So basically what I've been doing is I've been screenshotting the PM range. I've been screenshotting the lunch. This is New York lunch. Okay, the algorithm goes to lunch, but of course traders don't do it anymore, according to ICT. So I also was using patterns, which I'll explain. I'll actually explain how I actually knew this was going to happen right here. You see how price just streaming on by like this? I actually predicted this, and I'll show you how. Hold on quick. Okay, so I'll show you how I predicted that. But so this is intermarket relationships and knowing when to not take a trade. So I didn't take any trades today because the move didn't set up. Okay, because my move setting up is when price goes above this range right here from noon to 1:30, and then it retraces down to either consequent encroachment, which is 50% of this range, or sometimes it'll take out the lunch. This is the box for lunch, which is from noon to 1. Sometimes it'll take out the lows right here. And so I was expecting to do that, but it has to set up a certain way because I didn't trade London. I didn't trade New York Open, which I should have. I'll probably shoot a video on that tomorrow just to make these videos more consistent. So the reason why I didn't do it is because I want to go short here. Okay, what is this, 1405? I want to go short here, but if we go to 1405 on a DXY, which is here, at 1405, what do you see? Look at the numbers at the bottom. At 1405, you see what price respected this bearish breaker. And so if it respected it and price is in an algorithm, the algorithm is in a program to take out this low or to respect the order block down here, the last down close candle, which is here. You see how price, if you draw imaginary line out to here from that last down close candle, that wick, you'll see that's why I respected that. Now you see it's trying to go higher. That's the order block. So I understand how the breakers work. If it's respected, it's going to take out the low or it's going to respect a bullish order block. Okay. So that's why I didn't go short, because I'm like, okay, why would I go short when on US 30? Why would I go short? What just happened? Okay, so I'm like, why would I go short on US 30 right here and expect price to come down here so my move can set up? Because I get out here or at the lows. Consequential of the range or the actual New York lunch itself, this is 50% line, or it may take out the lows. But I actually have this stuff screenshot, and I'll tell you how I predicted that price literally did exactly what it just did. Like when I just saw this, because I stopped looking at price when price was here. I'm just not looking at price again for today. I literally looked at this about 15 minutes ago, and I said to myself, I was like, this is crazy. This is crazy how I literally predicted this. Now, you may see this squiggly line drawn right here, but this is before. This is when I was trying to figure out what prices are going to do. I was like, price will probably come up here, take out these highs. This is a bearish breaker up here, that shaded box, and it probably will go down here. That's what I thought it would do. But then when I saw more price action, I knew that price would just fizzle out, and it would be what I call a failure. Okay, let's see. I put it on here somewhere. I said it's looking like a failure day based on the pattern. That's what I put right here. It's looking like a failure day based on the pattern. So I like to use patterns and I like to use structure. Structure is king, but patterns actually do work. Okay, ICT don't like patterns, but patterns actually do work. But I love to use patterns and the structure, because patterns actually absolutely work, but you can't depend on the pattern itself. That's what people mess up. You have to use the patterns in relationship to the market structure, which is king. Okay. So yeah, so it's not going to be a long video. I'm about to end the video, but this is when to not take a trade. So remember, I look like I could have went short right here based on the way this stuff works. But when I went to DXY, okay, DXY respected this bearish breaker. Okay, you see that? This is a breaker right here. It went higher than this high up here. So the last down close candle is what you mark up. That's where you see the range right there. So why would I go short on US 30 when I knew I should have took a long? That's why you see right here, according to my notes, I say go long. And you see this is a green bar right here. You see, according to my green bar, I was like, okay, get in right here. And where are you going to get out at? I'm going to get out at this bearish breaker up here at the top. That's what these yellow lines are in this shaded box. So if you see one of my notes right here, it says, right here, it says it's bearish divergence on all three, NAS 100, US 30, S&P 500. But I said DXY has respected a 5-minute, I called it a mitigation block, a bearish mitigation block, but it was a bearish breaker. So go long right now. See, so I put that annotation when price was down here. So I said go long because I was about to go short, but I'm like, I need to see what the DXY is doing. And you see that it respected downward movement. So why would I go short when a DXY and when US 30 moves in the exact opposite of the DXY 85% of the time? So this is a perfect video of how to use intermarket relationships and when to not take a trade. I didn't take a trade today, and I feel good about it because my move didn't set up. Now, as far as this pattern right here, I want to show you the screenshots that I have that proved that this was not a trade to take. I actually predicted that price would do this. It would be a failure day, which is what I said right here. I was like, it's probably looking like it's going to be a failure day. But that's when price was right here. But when I saw price come up here, I was like, it's not going to take out this low. It's not going to take this low here. Okay. It still hasn't taken it yet on the wick. It did a double. It basically did a double bottom right here. So, it's just crazy how if you screenshot the patterns, you can see like this shit working out. It's crazy how I predicted that. Let me try to enlarge the screen before I go. I'm working on half a screen here. I got a new computer coming in a few days. So, all right, thanks for watching.